Our year-end sale is here. Get 80% off a CI Markets premium subscription for only $99 for the whole year. Get AI-powered forecasts of over 1,600 assets across stocks, ETFs, Forex, commodities, and economics. With 94.7% forecast accuracy, this tool helps traders and investors like you make smarter decisions and plan portfolios better. This promo ends December 31st. Go to completeintel.com/year-end to learn more. That's 80% off CI Markets at $99 per year. Hi, everyone, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Brent Johnson, Tracy Schuchart, and Albert Marko. As we head into the end of the year, we've got a few things we're going to talk about today. In 2024, obviously, we're looking at growth, disinflation, central banks, dollar. We'll talk with Brent about that. With Tracy, we want to talk a little bit about fracking and crude quality and kind of the surge of exports we've had out of the U.S. and Texas lately. And then with Albert, we'll talk geopolitics, and we're looking at the Yemen-Red Sea shipping risk and kind of what's really happening there and how long it will last. So, guys, thank you very much. I know we're headed into a holiday weekend, so I appreciate you taking the time. Brent, and again, thanks for joining us again. So
Sure.
I want to start with the Fed, because we had this meeting last week where everything's dovish now. I honestly don't know what to think about the Fed. Are we higher for longer or not? I saw one bank, it's a European bank, so that kind of helps you to understand, but saying that we'll have 275 basis points of cuts in the first half of the year. So it seems ridiculous, but I think nobody really knows if we're going to have 5 cuts in 24 or 2 cuts or no cuts or whatever. So, and Bostic was out earlier this week saying that we'll have 2 cuts, but we have other Fed presidents saying other things. So, I think we're in this mode where I don't even think the Fed guys are aligned on what they do. So I guess what I'm confused by is, why is there so much hope for cuts when we're told that growth is fine? We're told that inflation is fine. We're told that retail sales are fine. PCE in Q3 was just adjusted to 2%, so PCE is fine. So we're at a 5.5% Fed rate, and markets are flying. So why the urgency now? And I put this tweet up on the screen. Somebody, Deep Sale Capital, I don't know who that is, but they basically boiled this question down, and I wanted to prep you for this. So why the urgency now, Brett?
Well, it's a very good question, and to be honest, I'm really not sure myself. It was a very fast change of tone from Powell. On late November, December, early December, he was higher for longer, and 2 weeks later, he says we're considering cutting rates, basically, and didn't push back when people kind of challenged him on it. So there's clearly something going on. I'm not quite sure what it is. I have a couple theories. I think the most prominent theory right now is that it's political, right? They don't want to have a recession going into a presidential election, and if we had a big recession right in front of it, that could be bad for Biden, and that could be seen as a political move, or vice versa. There's other people on the other side are saying if he gooses the economy going into the election, that's political too. But I think that could be part of it. I think the other part of it is that potentially they have access to information, or they see some things coming that the rest of the market doesn't. And if they are going to be cutting after so recently saying that's higher for longer, they must see some bad things on the horizon that nobody else sees, or the rest of us don't see. And one thing I would say is I think the market has reacted correctly, directionally, to the news, but I think the magnitude of the moves have gotten way ahead of themselves. So, equities rallying on a dovish pivot from the Fed makes total sense. And this goes all the way back to the previous Fed meeting, because they were somewhat dovish in that meeting as well. And, markets have gone straight up for 6 weeks. Yesterday was the first significant down day in a really long time. And so to me, everything is kind of priced to perfection right now. And we just live in a very imperfect world. So I agree with the direction. I disagree with the magnitude. And for me, it's kind of easy to decide what to do right now. And that's to do nothing and to, if anything, hedge the downside. Because to me, everything's priced in to the upside already. The other thing I would say is that some of the criticism of the Fed is warranted, but some of it is not. And the thing is, regardless of what the Fed does, they're going to get criticized. Some people there's a whole industry that has been created and designed to criticize the Fed, regardless of what they say. And so let's say they do see some slowdown in the economy coming. I mean, at the end of the day, the Fed wants to slow the economy. That was the whole point of the rate hikes to begin with. That is the way they thought that they could tame inflation. And so while they want to slow the economy, they don't want to crash the economy. They don't want to have a global financial crisis that they cannot control. And so if you take that into effect and you consider how far they went in such a short period of time, from 0 to 5.5%, and now let's say that they see some success, they think the economy is going to start to slow, but they don't want to crash the economy, then it does actually make sense to start cutting before you get to the 2%, right? I mean, and so, he even said that in his press conference, if we don't start cutting before we get to 2%, then we risk going past 2% and getting into severe deflation, which they don't want severe deflation. So, if you think about it like landing a plane, you don't want to land the plane going full speed. You do kind of want to come in on kind of a smooth path. And so maybe there's some of that going on as well. And the final thing I'd say just on this is that, the people at the Fed are not stupid. Now, they may be misguided, they may be out of touch, they may be arrogant, but they're not stupid people. And so if they are now signaling that, no more hikes and probably cuts, there's probably a reason for that. And I think people should take that into account when they're, buying the all-time highs and all these assets.
Oh, yeah. So go ahead, Tracy.
I had a question, right? Do you see a scenario which we're going into an election year? Obviously, there's a lot of political things going on. Nobody wants a recession heading into this next election. But do you see a scenario of which we have Fed cutting, you have Yellen still issuing bonds, and obviously fiscal spending is not going to stop. So do you see a situation where this could reignite inflation?
Yeah, potentially. It all depends on why they are now moving to cuts, right? If they are moving to cuts because they are trying to, combat this deflation that they see on the horizon, then it just depends. Maybe if the deflationary forces outweigh the cuts that they're doing, then you can still get deflation. But if those deflationary forces don't show up and they start easing again, it definitely risks the possibility of a further acceleration of inflation. And I think that's the last thing that Powell wants, which is why I kind of feel like there must be some reason that he's risking inflation reaccelerating. And I wish I knew what it was. I don't, but it's a very good question, and that's what's got me thinking the most, is because nobody thought he would go to 5.5% in 12 months, but he did it, and nobody thought that he could do it without crashing the markets, but he did it.
Yep.
And so, and I think the reason that he did that is he didn't want to be another Arthur Burns. I think his legacy is extremely important. He's already got all the money in the world. He doesn't need any more money. The only thing he has to protect at this point is his reputation. And I think that's a big thing for him. So for him to risk inflation reaccelerating, I think he must see something that perhaps the rest of the market doesn't see.
Yeah, before Albert jumps in here, I want to say a couple things. First, I agree with you that although I mock the Fed on occasion, I actually think they've done a really good job of kind of getting us into this zone of acceptability. It's taken longer than a lot of people wanted to, but the magnitude of their actions was actually really fast. So I think they could have hugely miscalculated, and I actually don't think they did terribly. So because, these are broad policy, decisions they're making. And so, you don't really know where it's going to hit. And they actually, I think, did a really good job, despite a lot of their kind of personal defects or whatever. Like you say, they are smart, and they did a pretty good job of landing us where we are. I do think, though, I hear you say the election year, but it is pretty normal to hike in an election year, right? If we look historically, like it's not a completely abnormal thing. Of course, we didn't see that in 2020 because we had COVID, right? But it's not abnormal to hike or for the Fed to adjust monetary policy in an election year. Is that right?
I don't think it's I don't think, no, I think you're correct. I don't think it's abnormal. I just think we live in sort of abnormal times where everything is managed now. And, for the last, from, let's call it 1980 to 2020, we lived in a world that was globalizing and getting closer and working closer together. And for the last 4 years, we're now in a world that is fracturing, and supply chains are not getting more efficient; they're becoming less efficient.
Yep.
And
right.
We've got geopolitical issues that we didn't have the whole time back then. And so I just feel like, and as a result, and the fact that the debts have gotten so big everywhere. And this is what I don't think a lot of people realize, that there's a lot of people out there who think that inflation is here to stay. And, it's 2020 was a game changer, and the government's response ensures that we're always going to have inflation. Listen, I can't say that that's not true. Maybe we will have inflation going forward, but with the type of system that we have in a debt-based monetary system, you always risk deflationary shocks. Because if the economy is not moving and money is not circulating, you will get defaults. And when defaults happen, there's always the risk that it becomes contagious and it jumps from one place to the other.
Yep. I want to talk about deflationary shocks in a second. Albert, what have you got?
I mean, I agree with Brent. 80-90% of what he says is pretty much correct. But I'm one of those guys that I like to look at who's in charge and what have they done in the past. And for me, Yellen's been doing the exact same playbook as she did in 2017, where she took the VIX to 9.7%. She had 12 weeks. I looked at the chart. There was 12 weeks of up markets at that time. It was crazy, right? Trump at that point with Mnuchin ousted her. I mean, they just got rid of. They didn't reappoint her for the position, so that was done. She was done at that point. But the biggest thing that we should learn this year is, the Fed wants inflation. The reserve currency guys don't do debt jubilee, so they're using inflation to do whatever soft landing plans that they have in the mix. To cut corners off your currency. They had multiple chances to cut inflation all of last year, in which they emphatically passed each time. Now we can debate whether it's economic problems on the horizon, or political strategy, by certain members of the Fed and the Treasury. That's something else. But I mean, for me, U.S. stocks love 1% GDP growth, which by definition means 65% of the rest of America is already in a recession. I mean, nobody wants to discuss those things, but
right,
going into an election year, we're definitely gonna hear more about it. I just don't see inflation easing up. I've talked to quite a few people that are connected up into the Fed, and they're looking at inflation and starting to worry once again. And I don't so cutting these rates is cutting rates is a very dangerous game with inflation still a problem, in my opinion.
Okay.
Well, and let me can I just follow up really quickly, and that is, the other thing, again, I think the markets have reacted correctly directionally, but just the magnitude is way too big because you got to remember these dot plots. It's just what each person thinks at that time. And they can change their mind. It's not a unanimous thing. They don't all agree on the dots. And, again, it is true that if you don't want to crash into 2% and you want to glide into 2%, then you probably want to start cutting as you get closer to it. But if we don't see continued movement towards 2% inflation, we're not going to get all these cuts. In other words, all these cuts are not guaranteed. And that's where I think the market has just gotten way ahead of themselves. And I think that while they haven't necessarily misinterpreted the Fed, I think they have sort of misinterpreted the Fed's intention to not let inflation just totally run away again. Now, again, it doesn't mean that won't happen. It doesn't mean it won't get away from them. But I don't think that they have just pivoted and said, we're cutting rates no matter what, inflation be damned, and we'll just deal with the consequences later. I think they're trying to get the soft landing is what they're trying to do.
Oh, without question, they've said that over and over and over again for 2 years. There's no question they're trying to do that. I think the magnitude of this mood. This is a question for you, Brent. Is that you think a lot of it's to do with just the liquidity of the market in this time? I mean, right now it's the holidays; nobody's really there. Things can move quickly.
I think it's that, but it's also, again, directionally, I think it makes sense, but the dollar has sold off a lot. And as the dollar sells off, that provides liquidity to the whole world. And that's why you've seen financial conditions ease so much. And part of it is also that everybody's just front running the Fed. They're not front running the ECB. They're not front running the other central banks. And the idea that Europe, which is already basically in a recession, is going to out-hawk the Fed over the next year, to me, just doesn't make a lot of sense. And so, if we get a bunch of cuts, then, what the dollar has done and what the equities have done makes sense. But again, these are all priced in, but they're not guaranteed. And we could very well be in a situation where Europe is cutting aggressively in order to fight their recession, in which case the dollar probably rises versus the euro. And so, again, I think 2024 is going to be much more challenging than 2023. And in fact, I think 2024 could look a lot like 2022. I think we could have a lot of volatility in the first half of the year. And then, as we go in towards the second half of the year and the election, things perhaps calm down a little bit. But yep. I think the first 6 months are going to be very volatile.
Yeah. One of the things that whenever we talk about the Fed and kind of what their, the rate intentions are is, Powell and the Fed have said they want to normalize rates. So we had ZIRP and NIRP and all this other stuff. And 5.5%, to be honest, historically is not a high rate.
No.
So if we're normalizing rates, if we see cuts coming, what is that normal rate? Is it 2.5? I mean, we don't really know the answer to this, but we don't have, let's say, the demographic issue that Japan has, where they have to have NIRP to make up for productivity, right? We don't have the demographic issue that Europe has, where they have to have low interest rates to make up for a lack of productivity. Similar argument could be said for Korea, China, at least, in the next year or so. So 5.5%, I hear people act like these interest rates are extremely high, but really from a historical perspective, are they?
Well, they're not high from a historical perspective, but what's different from previous times in history where they was this level is the level of debt and the level of debt that was taken on at very low rates. And so what I mean by that is there's a lot of debt that, let's just say, that was issued sometime in the last 10 years, 5 to 10 years. And it was issued when rates were, 0 to 1.5%. And now that they're getting reset with interest rates at 5.5%, perhaps their car payment is going, I'm just making something up, or their mortgage, goes up from a $500 payment to an $1,800 payment, or whatever it is. And so, and the speed with which rates went up and the speed and the magnitude of the difference of where the debt was initially taken on and where it's being rolled, I think is much different than in previous points in history where interest rates are at these same levels.
Right. Okay, that's fair. I want to, before we get into the next.
I'm gonna jump up and turn these
Oh,
shades
sure.
down
Okay.
because the sun's still coming right in my house.
Okay.
That's something they don't see in Nebraska very often.
That's
Sun.
right. That's right. So, Brent, while you're doing that, I want to ask a question about Japan. Okay, we've had all sorts of discussion about the Bank of Japan and them potentially tightening, taking on different tightening activities. But why would the BOJ tighten if we have a Fed that's loosening? Because that effectively makes them uncompetitive in terms of exports. We'd see the yen jump dramatically in value, right? From an export perspective, you know, their competitors are Taiwan, Korea, and China, right? And those guys are not putting on, you know, tighter, they're not tightening at all. So it doesn't make sense to me that Japan would start tightening right now. Does that make sense to you? I mean, I hear the chatter every day, but I can't quite put it together why they would start doing that.
Well, I think part of the reason that they were doing it was the currency fell 30% in 2 years, which that's an absolutely enormous move for a major currency. It's not totally unheard of for an emerging market currency, but for let's call it the second or third biggest currency in the world, that's a massive move.
Mhm.
And then for the first time in literally decades, they were starting to get inflationary pressures in Japan. And so I think there was some pressure. The currency just kept falling, starting to get inflationary pressures. I think there was some political pressure internally to get off of zero and get somewhat, I mean, again, if you even go to 0.5%, that's nowhere near normalization, but that's a big move for Japan. So I think that is part of it. But I agree with you, Tony, is that they can't really strengthen their currency a lot. If they raise rates too much, their entire banking system comes under pressure because, you know, their banks, their pension funds, their endowments, all these different local, you know, the insurance companies, they own, you know, trillions of dollars of zero and negative yielding JGBs. They would face the same thing. They would potentially face the same thing in Japan that the US banks faced last March.
Yep.
Rates go up, the bonds fall. If the banks then have to start liquidating those bonds, those JGBs that are now completely underwater, you know, they could have, so they cannot out hawk. They can out hawk the Fed or some other on a short-term relative basis, but they are not going to get to a point where their interest rates are higher than these other central banks because it would
Blow up.
decimate their economy.
We'd have BTFP to the 10th power or something like that.
Right.
So
exactly.
Okay, so I want to take a look, and all of you guys kind of jump in here. But Brent, you say that 2024 is priced to perfection. So what do you see as the biggest potential downside risks? And I'll name a few, but let me just name a few things. So Fed miscalculation, unexpectedly strong dollar, which you mentioned in a tweet, I don't know, last week or something. US commercial real estate, US election related volatility. And by that, I mean fiscal overspending, political overreaction, that sort of thing. Bank of Japan changing really anything. China real estate, CCP miscalculation, German deindustrialization, Middle East geopolitical risk, oil prices. Like, you know, there's a lot out there that can
all that stuff, all of that stuff is, and that's the thing is, I don't know what it's going to be. I just know that there's all these potential things that you just rattled off. I mean, there's a couple dozen right there. And yet the markets are priced as if, you know, everything's beautiful and there's no potential problems on the horizon. And you know, that markets do, they climb a wall of worry. And I'm not saying we're going to have a collapse next year. I'm just saying that everything is kind of priced as if all these cuts are for sure, as if Europe's not going to start cutting rates, as if there's not going to be any problems in China or Japan, and as if, you know, geopolitics is all going to just take take a rest and have no more blowups.
Yep.
And I just don't think that's the world we live in anymore. And I think it's more likely than not that we're going to have some kind of an outbreak of volatility. Now, whether that takes place in, you know, the Middle East, which I think Albert's going to talk about, whether it takes place in Japan because they're messing around with their interest rates, whether it happens in the US due to commercial real estate, I'm not smart enough to know that. What I do know is assets are all the way back to where they were 2 years ago. They're back at their highs. Volatility is almost as low as it's been, not quite as low as what Albert was talking about with Yellen 5 or 6 years ago, but very low historically. And, you know, history has taught me when everybody is doing the same thing, that's about the time that they're going to get hit upside the head.
Yep.
And, you know, to me, it just makes sense to be prudent right now. I mean, you can, again, this is not advice, but I'm just as an example. Right now, basically, every asset class is within 10% of where it was January 1st, 2022. And the VIX is very low. And so, and we've got interest rates at 5.5%. We've got geopolitical problems, all these things that you mentioned. You can buy a put on the S&P 500 that is like 1% out of the money through June. So 6 months duration, 1% out of the money, and it will cost you like 2% of your portfolio. So let's pretend that I'm wrong. There's no volatility in the first half of the year and markets rip another 15, 16%. Okay, so now you're up 13 while everybody else is up 15 or 16. That's not horrible, right? You still made money. But if we do get some volatility and, you know, we don't have this perfect market that everybody seems to think we're going to get, and we have a repeat of 2020, the first half of 2022 and 2024, and, you know, equities are down 10, 15, 20%. Now you're down 1 or 2. I mean, to me, that's a pretty good risk reward. Mm-hmm. And so with assets the way they are right now, I'm much more inclined to buy protection than to put on leverage.
Right. Tracy, of those things that I mentioned, what are you, or other things, what are you looking at as risks for 24?
I think commercial real estate is definitely a risk. How that kind of pans out in the market, and does that cause a contagion in other areas? And I think I think everybody kind of sees that right now. I mean, it's not, you know, that's kind of been an ongoing saga, but how that plays out will be very interesting. And will the Treasury or the Fed have to get involved again, as they did with, you know, in March with SVB Bank failing, right? Are they gonna let the commercial real estate market fail entirely, or these banks that are backing the loans, I should say? So I think that's definitely something to watch out for. You know, but I think that's a freight train everybody's kind of already watching, to be honest. And I do think that, you know, if the government or the Federal Reserve kind of has to get involved on the banking side of the issue, they definitely will. But again, you know, does that cause a contagion in other markets?
I saw a story, I mean, this is pretty common every day. Some building in LA, the value is like 50% of the loan value. And
Yeah.
so, you know, this is common, right? And so,
well, I'll give you, Tony, I'll give you a good
Yep.
real world. So I'm back in San Francisco now.
Yep.
For the holidays, and this is kind of a hilarious story. But so the office that I used to work in when I lived here was in the old Federal Reserve building in downtown San Francisco.
right,
And it was privatized years ago. And in January of 2020, when I was still working there, the landlord of the building, or the owner of the building, sold literally January of 2020. Think about the timing on that, right?
perfect.
And so he timed that perfectly. And now the owner, a couple months ago, turned the keys back into the bank. You know, just not making any money, can't meet the mortgage, gave the keys back to the bank. I was going to go into the office, but I didn't, because the bank is now running the building and the heater blew up and they haven't fixed the heater. So there's no heat in the building. So
It's always HVAC and stuff like that these guys skimp on, right?
yeah, but yeah, and that's so I mean, that's just one example. Now, does that mean that's happening to every building? No, but I'm sure it's not the only one either, right? And my colleagues have already said that when their lease is up, and I don't know if it's this year or next year, they're not planning to renew it, because they're mainly working from home anyway, or they're working remotely, and the bank's not doing a great job of, you know, managing the building while they have it. So
Right.
Anyway, I just wanted to give that little anecdote.
Yeah, no, I mean, this is what we're seeing, right? And a lot of this has happened because of work from home and people just aren't, filling these buildings to capacity or close to capacity like
Yeah.
they had. Albert, what are you looking at for risks in 24? You've been talking particularly about banks, US banks, for a month or two. Like what are you worried about within US banks, and what else are you worried about?
A little bit of what Tracy was talking about, the commercial real estate and the loans and whatnot. I think, from what I hear, Bank of America is in pretty deep trouble. Whether they're insolvent or not is quite a question that I'm probably gonna have to look at in 2024. Now, do I think they'll fail? No, because Powell likes to bail everybody out. So, but any kind of rumors or murmurs of Bank of America insolvent would definitely cause the market to take notice.
Right. So between big banks like B of A, between the regional banks, between commercial real estate, these are probably the things that you guys are looking at.
Yeah, and and as layoffs kick in, loans start defaulting, debt starts going higher, credit card debt goes up. I mean, it's just it snowballs at that point.
Well, the other thing is, we don't have the perpetual noise every day of inflation is rising. And so we don't have, companies can't go out and put a 5% price rise or a 10% price rise or whatever, like they were doing in 21 and 22 and even early 23, right? So I think I was looking at General Mills. There was some announcement from General Mills yesterday, and they were saying, hey, we can't change the price by volume anymore because consumers won't take it, right?
Yeah,
So,
they had that. They had those tailwinds of inflation that helped earnings, but I don't. That's certainly gone. So earnings in the first 2 quarters of 2024 are going to probably be really bad.
right. And so this brings me to a tweet that Brent, that you sent out earlier. You said, one thing to remember is you don't need a flood of new sellers or buyers for the stock prices to begin to fall or rise. You just need an absence of new buyers or sellers to show up, right? And so, whether that's, products for General Mills, or whether that's equities, if buyers don't show up because of these risks, or because we're not getting this perpetual noise that we need to be afraid of inflation, we could see things change pretty quickly, right?
Yeah, and again, this is why when markets get to an extreme, whether a extreme high or an extreme low, that's why they typically reverse, right? Because markets don't move in a straight line. Like, I actually believe that we're going to see much higher equity prices in the years ahead, but I don't think that we're going straight higher from here, because markets, pendulums swing, and it's when you get to clear to one side, that's what kind of provides the energy to then swing it back the other way. And, at the end of October, we do a weekly show with my friend John, and we were talking about how sentiment had gotten pretty low. And it wasn't totally low, but it was close. It wasn't extreme, but it was getting pretty close to extreme negative. And we said it wouldn't surprise us if the market bounced a few weeks coming out of the Fed meeting, because markets don't go in a straight line. Now, since then, and so we got the 2 weeks, which I was expecting. I was not expecting the subsequent 3 or 4 weeks that we have now got. But now markets are up and until yesterday. Everything kind of switched yesterday, and we'll see what happens over the next week. But markets had gotten more extreme to the upside than they were to the downside, as far as sentiment and relative strength and all these different ways to measure where you're at on the positive or negative, had gotten even more positive than they were negative back in October. And so, the speed with which things move now, that's something else that's a little different. Over the last 4 years, the speed with which we swing from positives and negatives, I think, has increased dramatically from where we were 20 years ago. Yeah. And everything kind of moves in unison, right? I mean, it used to be that you'd have a sell-off and maybe you'd stay down for 2 or 3 months, and then it might take 6 months to build all that back up. But now, you get huge 10% swings. It's not that common to have 10% months in equities. It happens. But typically happens in big bear markets, because you're rallying from oversold levels. I just feel like the swings that we've had over the last 4 years, if you go back and look at the charts, they're just like big V's and W's. There's not a lot of U's in there. There's not a lot of N's and U's. And I think that's the world we live in, because again, we've gotten to kind of this super debt cycle where the debts are so big that if the central banks and the monetary authorities and the governments don't react quickly, you're going to get some very, very bad things happen. And so, I don't know if that helps move the conversation at all, but I just think that that's, again, where we're different now than we were maybe 20 years ago.
We're seeing that in everything, even like oil. I've been watching oil a lot lately. So
Perfect example.
I'm like, how are we having 5% moves on day-to-day basis? This is crazy,
Great. Albert, that is a perfect segue to move to Tracy. Tracy, let's talk about crude quality. And shale. I saw some stories earlier this week about how Texas is exporting a bunch of shale this month for tax reasons or whatever. And you said it's kind of boring, which is fine, but it's interesting to see those levels. I'm curious about shale and the quality of crude that we can get or that we're getting from shale. On the screen, we've got an exchange between you and Ralph, who comes on the show pretty regularly, on crude quality and gassy wells and this sort of thing. Can you talk to us about that and why it's happening and why it's important?
Yeah, absolutely. So when we're talking about US shale right now, right, and we're seeing all these rig declines, but we're seeing US shale volumes increase because of better technology and whatnot. That, I won't go into the minutia of how they're drilling these wells. But what happens is when you do that, yeah, you're producing more. But what is happening is that what you are getting out of these wells is gassier and gassier. And what I mean by that is that you're producing more natural gas liquids, which is technically not oil. Those are things like natural gas, propane, and other things that you can use for chemicals, but you can't use that as an oil substitute. And so over time, what is happening, because we're trying to stretch these wells out, these well productivity out, is that what we're getting out of these wells just happens to be lighter and lighter and can't be used for necessarily the same things that oil could be used for. In other words, you can't use it to refine gasoline out of, but you can use it at a chemical company to refine chemicals out of. And so it's totally, it's a different kind of makeup of what these wells are producing. And as they try to stretch this, we're getting more and more of this type of product.
Okay, so why does that matter? Like, how much of what comes out of a well is used for gasoline versus other chemical products?
I mean, that's a very loaded question, because it depends on, is it oil sands? Is it, US shale? Is it deep water? So that's totally going to matter, because there's totally different crude quality. But what that matters is that when we're looking at these numbers, shale is at, 13 million barrels a day plus right now. So everybody's like, oh, shale is back. They're producing more than ever there. But again, it's not actual product that you can use for traditional oil producing products. In other words, I mean, it's great for the chemical industry, because that means they can buy more and it's cheap. So, it's great for that industry.
I just want to go back. You said if we see that, say, Texas is producing 13 million barrels a day, that those barrels are it's not necessarily oil.
Correct. They count NGLs, which are natural gas liquids, into the entire crude production. And this is what some people had a problem with EIA and how they were reporting it. And so they made a little bit of a change that just came into effect this last month, that basically they segue out the difference between what is actually an NGL and what is, traditional oil, so to speak, within the weekly reports now. And so you can see that number, even just over the last month, has grown.
Okay. So what does that mean for these upstream companies in terms of profitability? If there's more crude in those barrels, do they make more money?
Well, I think.
Sorry to be so basic. I just.
No. I think how you have to look at this is that really, I think it comes down to mergers and acquisitions right now, to be
Mhm.
honest with you. If we look at this, we have a ton of big deals that went on this year. I think if you look at the Dallas Fed survey just released yesterday, 77% of all of those producers surveyed said, yeah, we're going to expect to see more M&A. And you can see this. And if you look at what's the survey of how much do you want to produce, right? You see all these smaller companies are planning to produce as much as they can. All the majors don't want to produce anything and are just looking for acquisitions. So I think that's really the dynamic we're seeing right now is we're having all these smaller to mid companies trying to produce the heck out of these wells. So they look productful so that they get bought out by the majors. And I think that's what's happening in the industry as far as production is concerned. I think it all boils down to business right now.
Okay, and so why are they pushing to be acquired? Are they largely debt funded as companies?
Not necessarily, but the deals that are going down right now are huge and way more than you're making if you're a small company that's basically just producing NGLs at this point.
Right.
Right. And so if you make your wells look more productive, you get these billion-dollar or billion-dollar deals going on, right? And that's very attractive to you.
Okay.
And
But the guys who are
go ahead,
Brent,
the
sorry.
majors are no, sorry to interrupt. The
Go ahead.
majors are buying them. They're basically buying new revenue, right? I mean,
Correct.
because they're not growing themselves, so that's why. Okay.
Exactly.
Yeah. Okay.
Great. Okay. That's good. Thank you for that. I think it's a lot more complicated than I'm used to seeing. I'm not an energy expert like you are, and sorry for the dumb questions, but I just need to make
No
sure I
dumb
understand why this is
questions.
happening.
Can I ask a question? Can I ask
Yeah.
a question related to that? Is there a, I mean, I'm sure there is somewhere, or are you familiar with estimates of how long these shale companies can pump at this, magnitude? Is it 2 years? Is it 3 years? Is it 7 years?
I mean, those estimates used to be a lot shorter, but with new technology, they're kind of pushing that out. It's kind of like, energy, like, what is it? Gasoline efficiency, right? We're just pushing out the miles, but you have to realize most of the tier 1 acreage is gone. We don't have we don't have a new auction after yesterday till after 2025 because that's gone. So, as far as federal lands are concerned. And so basically they're pushing, it's the pedal to the metal right now. It's like, let's get out everything when we can. How long that can last, I can't tell you for sure, but I can say that, it's not forever. I mean,
But in general, it's lasted longer than a lot of people expected. Is that right?
Yeah, absolutely.
Okay.
And that's because of a lot of the new technologies that have come within the industry as well. So you have to factor that sort of technology in when you're looking at these wells. 5 years ago, we probably wouldn't have been where we are, today, had it not been for, we probably would have already seen a decline, in other words.
And Tracy, in the state of Texas, where I live, there really isn't much federal land. It's almost all private. There's a small amount of federal land. So when you talk about the federal auctions, how much does that impact a place like Texas where there's a lot of fracking?
Well, it doesn't necessarily. I mean, most of your federal auctions are going to be in New Mexico, Wyoming,
Colorado,
Colorado, Gulf of Mexico, offshore. That's where most of your federal lands are coming from.
Very good. Okay, thanks for that. Hugely informative. Thank you so much for that. Let's move on to geopolitics. Albert. Okay, everyone's
boring.
Sorry.
boring geopolitics.
No, not at all.
Nothing going on there at all.
There's nothing going on. Everyone's a Red Sea expert this week, of course. Houthis fired rockets at vessels. You guys know the story. And now the U.S. has a kind of a coalition that will protect ships in the area, supposedly. So several shipping companies, particularly Europeans, have opted to go around the Horn of Africa instead of transiting through the Red Sea to go through the Suez Canal. So like, what's going on here? Like, I've heard, some ideas that this kind of coalition of European vessel owners is really trying to strong arm DoD to do some things they don't want to do, that sort of thing. What's really happening there, and what are the impacts?
Well, I mean, the Houthis, because of the Israeli-Gaza conflict, decided to enter the fray and show the world that they're an actual force. I mean, realistically, they're not. They couldn't really hit Israel as much as they were yapping like dogs that they were going to destroy parts of Israel. So they started taking aim at ships that were destined for Israel, right? But they don't really know which ships are going where. I mean, you'd have to be an expert with the...
Or just aim at Zim.
Yeah, exactly. It's just, it's one of those things where the Iranians wanted to influence the area, and they use the Houthis as a proxy. I mean, it's an age-old problem going back 50, 60 years, where Yemen has been, a launch pad for communist insurgencies within Saudi Arabia. So this is nothing new, right?
Okay.
The problem is, these ships have insurance requirements, right? And once you enter a conflict zone, those insurance coverages evaporate, right? So for the ship owners, one, it's not very safe to try to go through there, and God forbid, a ship gets sunk and then you lose everything, right? And your insurance doesn't cover it, you're completely out of business at that point. Realistically, the cost of the Suez Canal passage versus the diesel that they're using is pretty much even, right? It's just a time factor at that point. Like, I mean, there's issues if you're carrying oil to Rotterdam from the Middle East that, the price can sway so significantly in that time frame. So those issues are to be assessed by the ship owners. Now, I have a fear that the U.S. might get a little bit brave and start, attacking some of the Houthi positions with drones or missile strikes or so on and so forth, which would probably affect the price of oil going into the market, and the markets would probably sell off, with a new U.S. war, so it was quote unquote. But I don't really give that more than like a 50-60% chance, but it's still there,
Okay.
certainly there.
So the Houthis, like, their air forces, like F4s made in the 60s or something, right? I mean,
It's a joke. I saw that tweet and I'm just like, they're like, bring it on, America. I mean, we can send some kids with PlayStations hooked up to DJI drones to take those out. I mean, that's a joke.
Right. So, I remember this clip's been going around for the past day or so, where it's George Bush from 2001 or whatever, talking about the coalition. And then he says, now watch me, watch my golf drive or something like that, right?
Yeah.
And it was like the perfect early 21st century American moment. And so, and at that time, a lot of these countries jumped into the coalition, whether they felt forced to or, supported America or whatever. But the sense I'm getting is that the Europeans, although they have claimed to be part of the coalition, they're not really doing that much. So
this is a perfect example of a unipolar world where the dominant superpower, the United States, conducts maritime security globally. Nobody else can do that, right? And
I'm glad you brought this up.
Yeah,
I'm so glad you brought this up.
Seychelles jumped on this.
I mean, Seychelles are the difference maker in this coalition, right? I mean, they are going to.
Yeah. I mean, this is why the U.S. is a reserve currency. This is why we are a unipolar world still, and for the foreseeable future. There is nobody else that can send ships and rockets and helicopters and manpower globally to choke points that trade flows through. This is the United States' world, and we're seeing it right now.
Yeah, but the PLA has thousands of ships, 94% of which are small fishing boats, right? I mean,
oh yeah, tonnage matters at some point, right? Whenever you talk to a real military expert, tonnage matters, right? When you have aircraft, when you have 21 aircraft carriers versus 5,000 fishing boats, they're not gonna matter much.
Right.
Well, I think this is kind of important, I think, for people to think about, because, you know, I obviously get in a lot of these debates regarding the US hegemony and still a unipolar power and the US dollar. And I'll often get the comment that, you know, aircraft carriers and Navy forces are no longer important due to, you know, hypersonic missiles and all this, you know, nonsense. But here's the thing is, number one, I don't believe that that's true, but let's just pretend that it is. Let's just give those people who say that the benefit of the doubt. And let's say that is true in some kind of a large war scenario, they're sitting ducks. Well, there's a lot of stuff that goes on that's not a large war scenario. And the fact is that the US Navy for several decades has kept the shipping lines open from things like the Houthis. Remember 10 years ago, you know, Captain Phillips and the Ethiopian, you know, pirates. That has helped keep prices down for everyone, not just for the United States. Now, does it benefit the United States? It absolutely benefits the United States. They're not altruistic in this, but it helps the rest of the world too. And if the US was not the hegemon and was not doing this, prices would be higher everywhere. Insurance rates would be higher everywhere. The lead time to get shipments from around the world would be much longer. And so I think that's one.
And insurance would be higher, right?
Insurance
All
would be
these direct costs, everything.
dramatically higher. And so, you know, and so that has inflationary effects, right? And so, you know, this whole thing that Albert's talking about with the Red Sea, this has the potential to keep rates higher for longer with the Fed. You know, this is how potentially Fed rate cuts might not happen as quickly as are forecasted, or even if the Fed cuts do come, may not have as significant an impact on the markets because of what's going on. In other words, they may have to be cutting in order to protect against deflationary forces as a result of markets selling off because oil's spiking and there's, you know, more geopolitical conflict in the Red Sea and the greater Middle East. And so this is just another part of what I was saying earlier is that, you know, markets are priced to perfection based on monetary policy, but there's a lot more going on than just monetary policy. And, you know, there's so many different ways that this can go wrong. It doesn't mean it will go wrong. It just means, I think, you know, markets move on expectations, and they are now fully expecting, the markets are fully expecting several cuts. And if those several cuts don't show up, markets are not going to be at the same levels they are right now.
Yep.
You know, they've been wrong for 2 years on this pivot, pause, cuts, so on and so forth. So I have no trust on these like 5, 6, you know, Fed cut stories out there.
275 basis points.
Yeah. Okay. Sure.
Okay. So guys, I want to talk more broadly about geopolitical risk. Okay. Because I don't know that a lot of people understand when the 2008 financial crisis hit, investment banks just gutted their geopolitical risk desks. Right. And so since then, I don't know of really any major banks that have, maybe credible is too strong of a word, but credible geopolitical risk analysis. So a lot of that's been outsourced to relatively small firms, right? Am I wrong on this? I don't feel like we really get a lot of credible geopolitical risk analysis from the banks, from the guys who should be able to price risk. Is that, am I off there?
They don't. I mean, Goldman Sachs has a new geopolitical division. I really haven't talked to them or seen what they've written, but just going on from previous interactions with the financial industry and geopolitical analysis, it's been truly awful. You know, they just don't, you know, it stems from them being so polar opposite, where finance guys absolutely do not believe that geopolitics makes a difference up until about, you know, 6 months ago. And now they're flipping because they've gotten blown out in their portfolios and they have to blame something, and it's geopolitical. So now they're all, you know, going towards the geopolitical analysis, but, you know, they're still, they're not good. Still not good.
Well, not only that, when they do exist, you got to remember the investment banks that put out research and the big commercial banks, I mean, they're basically sales pieces. I mean, it's very hard for an analyst at a major firm to come out and say something very negative. It's not impossible, but it's not easy. And even when they do try to put out something negative, you know, their higher ups will say, "Hey, can you smooth this out a little bit?
Sure.
Can you say this a little bit softer?" Because at the end of the day, they want people invested. They want people buying things. They don't want people to hunker down and do nothing, right? And so I tend to agree with your point, Tony. They don't really have these groups to begin with, but even when they do, you're not going to get the same kind of unvarnished, you know, truth that you would at perhaps an independent geopolitical firm.
And so we've got small geopolitical firms largely based in New York or DC or London. I used to be with one of them, and these are not people who have field experience, none. And so they're basically, it's secondary research. They're largely reading, and I just want to make sure that our viewers understand this. They're largely reading English language publications in these countries to come up with their assessments. Okay, so they don't really know what's going on. It's filtered through English language, whether it's Reuters or some local newspaper or something like that, right? And so that's really what geopolitical risk is today, with the geopolitical risk firms that you know that can come up. We don't need to name names, but the ones that come off your tip of your tongue.
Or even worse, you know, the big think tanks in the
Sorry?
US. I said, or even worse, the big think tanks in the US, and I'll just
Oh my gosh.
that, and I won't name names.
Well, no, I mean, look, the big think tanks in the US, many, you know, there are not a small number of their leadership who
They're
are
government
boards of
funded as
Chinese
well.
companies.
They're
Okay,
just
and on-
they're just so bad, Tony. I just had a discussion this morning with a finance guy in a firm up in New York, and he's furiously texting me, like, because I think they were trying to make a bond position. They're like, oh, Lavrov's plane landed in the United States. The Russian diplomat, you know, the foreign minister, the war is over in Ukraine, and blah. I'm like, what the hell are you talking about, man? Like,
Right.
that's most likely a taxi ride for the diplomats to go back for the holidays to
Yep.
Russia. What, like, that's not some bond move. You're completely mispricing everything and
Right.
making assumptions where you don't have expertise on doing, and they do that often, and that's why they're so bad.
Right. Now, I want to bring this back to crude, Tracy. If we have geopolitical risk rising in the Middle East, why aren't we seeing that in crude prices right now?
Well, first of all, this whole episode is a shipping move, and I've reiterated that over and over and over again in Twitter, because everybody said, why isn't oil moving? Because there's no risk to oil. Unless you
Mhm.
see the Houthis lobbing missiles at Aramco again, there's no risk to oil. Production is fine in the Middle East.
Right.
Production is not interrupted. So this is not an oil issue. Now, if you want to talk shipping and you want to talk, yes, now we have a shipping issue with not only containers, but also shipping with, you know, with the tanker and in oil and oil products market, as well as, you know, they're being diverted around Africa instead, you know, and in fact, you know, we're seeing, you know, tankers have been having to be diverted from Panama Canal for, you know, months now because of the things that are happening. So it's a shipping issue. And so that you're seeing shipping, you know, you're seeing shipping rates increase, and that you're seeing, you know, a bounce in the container and the tanker markets right
This
now.
goes back to what Brent was saying, though, with these outsized market moves. And this is what we've been seeing, is like any kind of headline, geopolitical, economics, so on and so forth, gets so blown out of proportion. Right. And Tracy's right. This Houthi thing is not a risk to oil. This is ridiculous. You know, they're not going to start blowing up Iranian and Russian ships and Chinese ships. You know, the Houthis rely on those people. You know, so it's just these outsized moves based on wacky headlines is here to stay. And it's definitely oil.
To my earlier point, people don't know how to price this risk because geopolitical risk analysis is so bad. People don't know how to price risk. So you have all of this volatility around these items. Either they underprice and dismiss it, or they overprice it because people are sitting in suburban New Jersey or whatever. They have never been to the region, have no idea what's going on. And so they overreact. Let's just, I know we need to wrap this up, but let's just get into real nitty gritty on the Middle East for a minute, Albert, on this Yemen issue. So the Houthis, their allies are Iran, Qatar, and really Oman, right? I mean, Qatar and Oman are kind of Iranian allies. Is that fair
but
to
the
say?
Russian, well, yes, for the most part, but they've also have links, long-standing links with the Chinese and and the Russians. I mean, like I've even tweeted out that the Chinese have barges sitting offshore that sells arms to the Houthis, and
Right.
nobody says anything about it. You know,
Right. Okay. And then the kind of sitting on the other side of that is really the Saudis and the Emiratis, right? Just
and
in
the-
terms
and
of
the
Middle East
Israelis.
dynamics, right?
Yeah, and the Israelis, yes.
And the Israelis. Okay.
Yeah.
But I doubt the Emiratis and the Saudis would really say that Israel is their ally. Do they? I mean, they don't really say that out loud, do they?
No, but it's common knowledge. I mean, the Saudis, I mean, the Saudis and the Israelis have been defense partners for 30, 40 years. This is nothing
Right.
new.
Right.
Yeah.
And so I think on one side of that, we have kind of chaos, right? Iran and, other stuff. And then we have kind of order on one side, which is Saudi and UAE, very orderly societies, Israel, very orderly. So the one I can't figure out, Albert, is Qatar, okay? Because very orderly place. There's a massive US base in Qatar. So why are they allied with Iran?
They're not just allied with Iran, but they're allied with Turkey on top of that. The little troika there sitting
Okay.
in the Middle East is because, they see the Saudis as a threat to their monarchy, right? So they need to counterbalance that with the Iranians, the same way that the Indians counterbalance China with Russia, and that's just the basic layman's terms reason of why they're aligned with the Iranians. They need a
Okay.
counterbalance.
So it's just balancing out. It's not,
Yeah, of
it's
course.
not that the Qataris are super empathetic to Iran. They're just worried about Saudi. So they're enemy, my enemy, that sort of thing.
Yeah, exactly. That and the Iranians are also right across the strait there. I mean, it's not
Right.
that far away. It's a stone throw
Right.
away. And their gas fields in the water are, they
share a
border.
bunch of that stuff.
Yeah, exactly.
Yep. Okay, very good. Guys, this has been fantastic. Thank you so much for this. We've got a lot to think about going into 2024. Have great holidays and have a great week ahead, and see you in the new year. Thank you very much.
Happy
Merry
holidays.
Christmas, everybody. Happy holidays.